Hi everybody, good afternoon. Nice to see you all, and thank you for coming and giving us the opportunity to present our company to you. For those that are newcomers, and to bring you up to date for those that aren't newcomers, a lot of familiar faces here today. I'm Bernard Johnson, the Group Managing Director. We are a public company quoted on the main exchange. We operate in the health and beauty sector, and we've grown rapidly in the last few years to 45 million per annum. We manufacture and market our own brands, as well as developing and manufacturing for other companies and other brands. A very significant part of our business is our full service private label contract for main high street retailers, grocery retailers, and drug companies. So that's our background. Pippa Clark will fill you in on the marketing and sales side, and Paul Forster, our finance director, will fill you in on the financial details. I'll just give you a little background of the last 6 months. We've continued to deliver for all our stakeholders, and that's really what we're about. We're about looking after our shareholders, looking after our employees, looking after our customers, looking after the consumer, and also our suppliers and contractors. So for our shareholders, we've increased cash, we've improved profits, we've moved up the margin ladder, which has made a distinct change in our percentage P&L account. We have awarded at least 7.5% and probably 10% to most of our employees in the last 6 months as part of a bonus, performance-based bonus. We've won awards for service and quality from our big customers, particularly the high street retailers. And we're winning new customers as well as extending business with our current customers. We have tighter and stronger partnerships with our suppliers and contractors. So all in all, in the 6 months to date, we have improved, moved forward, and I think it would be appropriate to hand over now to Paul and let him give you the detail of the financial results and the financial improvement. So Paul.
Hello everybody. I'll quickly go through the highlights that were published first thing this morning, and then go into a little bit detail on some of the others, and on the sales, etc. Pippa will cover where those margins and sales have come from later on. We've seen the revenue increase by 6%. A lot of that's come from growth within the private label division. As people will talk about, there's been quite a bit of sales mix within the revenue growth, so we'll talk about some of where that sales mix has come from. Significant improvement in the gross margin, and again that has partly come from sales mix, partly for our price increases, but very small amount, and probably the most significant part has been from cost engineering, renegotiating contracts with suppliers, and genuinely reducing the unit cost of the product we're manufacturing. So there's been a lot of work that's gone on probably over the last 18 months that we're starting to see the benefits of in the margin and the margin mix. Operating profits up at 7.7%. Talk a little bit about some of the makeup of that a little bit later on. And the profit before tax up by 28%, 1.8 million virtually from 1.4 million in the same period last year. Whilst I'm on this, there's a lot of talk about IFRS 16, and it has been a marginal impact on our results. The interest cost you see in the P&L account includes about £68,000 associated with that. The operating lease costs have come down, but the overall impact on the profit was £27,000 adverse in this period, bringing that into account. Haven't put that on the slide, but I just thought it was worth mentioning. On the balance sheet, we've moved about 800,000 onto assets and about 800,000 roughly onto lease liabilities. So there has been an impact. Most of that is to do with the lease in the site in Tiverton, as well as some of the things like forklift truck leasing contracts. Diluted earnings per share is increased by to 2.06, partly not quite as high as the increase in the growth in profits. And that's partly because we've got more share options in issue. So this is the diluted figure, assuming all those options are taken up. So we have motivated staff with options after the results this time last year. Those were put through, or just before the results this time last year. Return on capital employed up at 13% in the 6-month period. So well above the 20% we're looking at on an annualised basis as a target. And compared 11% in the first half of last year. We've kept the interim dividend at 0.15p per ordinary share. We've done that in the last few years and then looked at the final dividend in the context of the full year results. So we'll look at that again later on in the year, but at the moment we have held the interim dividend, which will go out towards the end of December. The significant change from this time last year is the cash impact on the business here. And that cash inflow from the operating activities is about 3.2 million. It was 1.3 million negative last year. And a large part of that reason is the swing in the increase in working capital. I'll talk about that a little bit later on. But the result of that is that at the end of September, we had 1.7 million pounds in the bank. And compared to 1.9 million overdrawn this time last year. So there's a big swing in the cash position over a 12-month period, as well as the operating cash generated in this period of 3.2 million. If I move on to revenue, we've got the first half and the second half in there just to give you a comparison. The 6.3% we've already talked about. A lot of that driven by the private label. Pippa will talk a bit more about that. Just again, a bit of a trend I followed in the past. You know, we're looking at that 6 months as double what we were earning only 3 years ago in a full year. So it gives you an idea where the business has come over 3 years. This period we announced that we bought the Balance Active brand, and that came in June. So we've had 3 months worth of sales. We inherited a brand that had a lot of out of stocks. So those sales, we've done 300,000 in the period. That has involved a little bit of additional cost to us as we've accelerated, managed to get the stocks listed fully and brought, including air freighting stock in from China to make sure we got the customers back up and running. And that's also been part of the sales mix, the benefit in terms of margin. That is a higher margin product range that's going to come in and we'll get a full year. It's already exceeding our expectations when we bought the brand and exceeding the performance of the brand with the previous brand owner. So we've got good hopes for that. So operating profit up at 30%. There's it stands for itself really. The gross margins. We have increased distribution costs. We mentioned last year that we've outsourced the finished goods distribution. We've now completed that exercise, so that exercise is fully outsourced in this period. We're now revisiting how we can, whilst we still need in the short term some external warehousing, we're now revisiting whether it's more cost effective to change the mix of products we outsource, and that exercise will be looked at over the second half of the period. The target there is to reduce the costs that we're incurring at the moment, and if there's a more cost-effective way of doing that. We may get the full benefit in the second half, but certainly we're looking at it for the future. Admin costs have gone up by 13%, and that's really twofold. We have increased salaries with staff, and we have looked at resources and what resources we need to build the business for the future. So there has been some investment in building the organisational structure to put the infrastructure in place to drive the business forward, if you like. Just looking at those margins, operating profit margins up at 1.4% to 7.7%. I think we set an aspiration of about 8% a while ago, so we're pretty close to achieving those figures now. Tax charges in at 14.7%. That is with our R&D tax relief that we've got, and there's some tax relief from the exercise of options, that is starting to come around about 15%, 16% is probably going to be a normal rate going forward for the business, as long as we keep those sort of levels of investment in research and development that we're delivering at the moment. And again, diluted earnings per share, I've already mentioned 14.4%, but then looking back to that first chart and figure there, we're looking at sort of 600% growth over that period, or nearly 700% growth over the period. Spend a little bit of time on the cash. We mentioned 1.75 million on cash on hand at the end of the period. Last year it was 1.9 overdrawn, generated an awful lot in that period. We have had the benefit of a tax refund, because when we did the R&D, we had a couple of years back that came into there. So there's about £268,000 cash in that generated from operations. Working capital is reduced by 566,000. So we have got a bit better, partly bringing stocks down, stock staying level, getting debtors under much better control. I'll talk about that in a minute. And also pushing the creditors a little bit has turned that from a big outflow as we grew the business rapidly. We've also, in that 1.75 million, we spent £500,000 buying the brand. So we bought that brand as a capital outlay over and above. And a little bit less capital expenditure. We had a lot of capital expenditure in the last 12 months as we had to build the infrastructure to bring back the products we've outsourced. That's levelling off a little bit to a more normal level. So there has been that, plus the benefit of lease financing there. So there's been a lot of levels. I'll talk a little bit more about the working capital in a minute. Just want to, before moving on, after the year end, we completed the sale or purchase of the property that we occupy in Peterborough. That was for, including the stamp duty and costs, we spent 4.1 million to do that. We got a mortgage, a 15-year mortgage from HSBC for 3 million of that. So the net outflow was 1.41 million. And you can see the 1.75 million there. It's still left us with lots of available headroom. We've got working capital headroom plus 1.7. We've got a lot of facilities available to facilitate growth with the group for the future, whether it be organic and investment in debtors and stock as we take on more brands, or whether it be acquisitions. There's plenty of resources and headroom within the business. Just looking finally at working capital, and it's a big change in the year. Stock levels have marginally moved up, very little. The stock turn is roughly the same. We still have a little bit of Brexit contingency stock in there that will fall away. We've unravelled all of that again, and don't have any intention of rebuilding now. We're just going to, a lot of the reasons for doing that, I think with two failed things, the infrastructure, the freight business and everybody else, I think everyone's got their act together now, so we're not expecting there to be as much of an impact as we thought there would be way back in March. But most importantly, we've got our debtor days down dramatically in the period. That's partly just a focus on it, new recruitment and getting more control, being stricter with customers, and really managed a big generation, which should be a permanent improvement in debtor days. And we've slightly pushed the creditors, but not significantly. We tend to be, as Bernard mentioned at the beginning, we tend to be a fair partner with our creditors. We find when we do need them to react, if we've paid them fairly promptly, they react more quickly than if they start saying, well, you're overdue, guys.
Have you made any write-offs that have contributed to that reduction in debtors?
Well, we always provide for debtors, and we review them before the year, each half year in detail, and look at provisions. So those will include what we would consider normal provisions for product end of life, etc., etc. But nothing out of the ordinary. Everything's on a fairly standard basis. I'll pass on to Pippa.
Thank you, Paul. Good afternoon, everybody. For those of you not familiar, Pippa Clark, I'm our Global Sales and Marketing Director, so oversee all of the functions with regard to selling our business and marketing our business and our brands. I'm going to give you a little bit more detail on the revenue number that Paul highlighted earlier in terms of the mix and how that's made up. For those of you that are already familiar with our business, you'll know that I call it our three-legged stool. We have three divisions to the business: brands that we own, contract manufacturing for brands that we manufacture for, and we also have a private label business where we work direct with retail here in the UK and now globally, developing, designing, supplying and distributing brands direct for retailers. There has been quite a significant shift in terms of the past 6 months compared to the 6 months in 2018 in terms of where the growth is coming from. And as you can see, private label at the moment is absolutely storming ahead. And if you look at the figure from 2018, with it being up to the degree that it was versus 17, you can see that private label is still very much on a very fast track in terms of what retailers are wanting. And that's predominantly because retailers right now are looking for product that is differentiated from their competitors. They've been through a huge period with big brands where all they've done is fight on price, and big brands have been diluted as a result. So now private label is back on the agenda with all the big retailers because it's a way that they can offer product to their consumer quicker. They can follow trends quicker if they want to, but they can also differentiate in terms of offer and value. So private label is doing very well, and it's doing well for us in all areas, actually, high street, grocery, and in the drugstore channel. So it very much is throughout the entire retail platform at the moment. Both contract manufacturing and owned brands, we've been through a period of kind of rebalancing margin. Paul's highlighted that margin performance has been a key driver for us for the past couple of years, and those that know us will know that that's an aspiration that we have been talking about for some time. And in both of those divisions, we've been quite thorough in going through what brands and products we've been supplying and where we've been supplying them based on margin and value. And as a result, we've got a slight decline in own brands of 3%, and we have a decline in contract manufacturing in that half-year period to the half year of 2018 of 8%. So highlighting private label and just giving you a bit more information in terms of how that's operating and the drivers for that at the moment. As I said, there's been significant growth in the UK market across all channels of retail distribution. We've got some really nice customers that are really moving forward very well in that area. A dynamic that's happened in the past 12 months, but particularly started to kick in now for the last 6 months, is actually we're also now developing private label internationally. Now that's an interesting development because traditionally private label is sourced locally, because traditionally private label is based on value and price. Because private label is becoming such an important, in fact, many retailers now call it exclusive brand as opposed to private label. It just shows you the thinking and how they're thinking about these types of products. Is we now have international partners that are doing private label programs with us, and that's because they're no longer buying low cost, low value products. They're really moving private label into added value categories. So we're doing a lot in hair care, a lot in baby care, bath and shower, and more recently we've won a contract in skincare. So these international partners are coming to the UK market that are the UK market is the most advanced in private label globally. And looking at the quality of manufacturing and the quality of understanding how to manage private label. And that's been a really interesting move forward for us over the past 6 months. And as I've said, we focus on margin enhancing value added categories. That means that our relationship with retailers on private label is really about managing brand for them. And that's why it succeeds for us in terms of these long-term partnerships in private label. Innovation and speed to market is key. That's one of our USPs in private label, and that's one of the reasons I believe customers come to us, as well as calling us a safe pair of hands in terms of technical capability. They value our ability to innovate and get product to market quickly. We've got some interesting things happening where one of the major retailers in the UK, advent calendars have been a big trend in health and beauty, but pre-Christmas, we came up with an idea for a big retailer that you'll see launched very soon about doing a New Year one. There's never been a New Year advent calendar on the market. So we're doing a big private label one for a retailer this year. And also skincare trends, ingredients and formats. That's where we're able to add value all the time to those private label programs. And as a result, we're winning quite a lot of awards in this arena with big retailers, not just in terms of overall supplier of the year, but also our service levels. Because the other consideration for retailers and private label is not just speed to market and innovation, it is also your ability to service them and their consumer. So the ability to forecast, hold stock, deliver day one for day three, ensure that that product is on shelf. That's a very important part of being a successful private label supplier. And that's where we win. We've won Service Level of the Year 7 years running for one of our major retailers in the UK. We're also their number one private label supplier now. And we've got probably 4 retailers in the UK where we're winning product awards and we're getting TV featured spots with private label in their advertising campaigns on TV, which again shows you the priority that retailers, particularly in the UK, are putting on private label by advertising private label stroke their brands on TV. Some highlights with regard to our brands and brand development over the past 6 months since we last presented to you. We are going back into the US market in mainstream in early 2020. We do continue to operate in the United States market in the off-price sector, which is the likes of TK Maxx, Ross stores, Burlington stores. We've continued that for the past 10 years. But we haven't been in mass retail with one of our core brands in the US for some time after we sold the 2 brands we were trading in that market. So that's a really exciting move forward for us that we've managed to score a listing with CVS on the Curl Company. We also have launched with Tesco with Curl Company. So that now means we're in Morrisons, Asda, Boots and Tesco in the UK with the brand, which is quite exciting in terms of its development. Beautiful was a new brand launch in May of this year that I was speaking about when we were here in June. Since then, we've launched in Clicks in South Africa, which is our first bricks and mortar listing. It's been in store now for about 4 weeks. We are launching on TVSN TV shopping channel in Australia in January. That is now confirmed. And Boots have finally confirmed listing of the brand for very early in 2020. So this comes on the back of, if you recall, those that know us, we launched the brand in May on Ideal World TV here in the UK. And that has done very well for us and it continues to do well. That is how the TVSN Australia opportunity has come about. And we're also talking to TV channels in both Germany and the US. So this has been a really interesting channel for us. And one of the spin-offs we have learnt is that whenever we're on TV with the brand, we get a bounce in our digital sales as well. So there's a direct correlation between being on TV and selling the product on shopping channels and our digital sales direct to consumer. I'll talk a bit more about digital in a minute. Feather and Down is a brand that is now going into its 3rd year. We're trading it very successfully in Boots and Sainsbury's here in the UK. We have launched gift programs for Christmas with both retailers for this year, which is new. And in the past 6 months, we have secured a listing with Etos in the Netherlands. They had it in 4 stores as a trial, and after 1 month, they decided to roll it out to 400 stores. So they're very pleased with the performance. And those of you not familiar, Etos is very similar to Boots in terms of its profile in the Netherlands, and is definitely a great store in that market to be in. And then finally, Balance, Paul mentioned, that was a brand purchase that we did back in June, started trading early July. So we've had 3 months in this period of trade. It is exceeding our expectations by 20% in just those first 3 months. Paul was quite right. We inherited a brand that had been starved a little of cash and stock. So our priority was to get back into stock and to make sure that we were servicing all of the great listings that it had, and we successfully did that. And as a result, the brand is now really beginning to motor and perform. So we're very excited about that over the next 6 to 12 months in terms of how far we can take that brand. Other brand developments that are happening, and again, both of these are focused on enhancing margin, is we are relaunching. We've had a brand out for some years now called Ingredients, which has very much been in the lower mass space, positioned at kind of £1 in the UK market, albeit in international markets, positioned more like £3.99. It's been very successful for us, but we're relaunching it under the Body Bliss banner, giving it a brand and a bit more of an identity. But we're moving it into trends that the consumer is now seeking. So cleaner formulas, the bottles are 50% post-consumer recycled plastic. The caps are moving that way in 6 months. It is vegan, it is natural ingredients. We've actually got the percentage of natural ingredients, which is 90% plus on each of the products advertised on the products. We have a really great global consumer base and retailer listing base for this brand already, and all of the core consumers and retailers that listed the original ingredients brand are continuing to list with Body Bliss. We are doubling its price in terms of retail. So we're taking it up in terms of position in the market because the additional elements that we're putting into it with regard to natural and post-consumer recycled plastic and cleaner formulas is justifying a better retail position. So this relaunches globally in February. And again, very excited as a team of that happening. One of the things you would have heard me summarise with regard to our repositioning in brands that was margin dilutive for us, we had 2 licensed brands, Emma Bridgewater and Humble. Neither of them were really delivering for us in terms of margin, and as a result, we exited. What happened with Humble is actually after we exited, Kate got in touch and said, look, I still believe in the brand, want to do it. Can we do it direct? I don't want to license it. I'd rather do it with you guys, more in partnership rather than a license. So we're currently in the throes of sorting that out with Kate, which gets us in control of the brand. It gets us in control of the social media. It gets us in control of the digital platform. And it enables us to really invest in this brand because we're not, as a license, we'll be a brand owner in this brand as opposed to license. So we've maintained all the listings throughout that period of transition and really pushing forward with what's happening with the Humble brand. So we hadn't really invested heavily whilst it was a license. We were trading it. So our intention now is to really accelerate that in terms of new product formats and a big gifting program for next Christmas. Digital, again, has been on our agenda for some time. We have invested resources in digital, and over the past 6 months, we're beginning to get some momentum in the time, effort, and resources that we're putting into this area of selling direct to the consumer. We trade under a number of brand websites. Creightons.com is the main one, but we are also trading through bambeautiful.com, balance.com, curlcompany.com, and featheranddown.com. And as a combination of what's happening there in terms of performance, we're getting up to sort of £600,000, £700,000 in our first 12 months of going direct on digital and consumer, pretty much from a standing start. And each month as we go by, we're gaining a little bit more momentum, learning a lot, building our databases, investing more in social media, and just working closer with the consumer. We've got a big Black Friday program coming up for the end of November, which is going to be an interesting learning experience for us in terms of how that might execute and what that might bring to us during November. And then obviously the big push running up to Christmas time in terms of what's possible there on digital. So drivers for growth in terms of what our priorities remain margin enhancing business and continuing to climb that margin ladder in all 3 divisions. I hadn't highlighted it, but that growth in private label has also brought a 3.5% increase in margin on the division as well. So the private label business that's coming in sales growth is also coming in margin growth as well. So again, it's that value added business. So in terms of driving the business forward, we've invested in the sales team. We want to work harder at selling our brands, both in the UK and globally, with a dedicated sales team. So we've brought in a new head of global sales and we've brought in a new UK sales manager, both very new to the business, but the start is looking good, so very promising. We will continue with our vision of partnering with winning brands and retailers. I think this is core to making sure that we have a business that is consistent and that a business that can deliver. And that is working with retailers globally that understand brand and understand the consumer. I think that's very important. And the UK retailers that we're doing very well with are very close to their consumer. They really understand what the consumer needs. And that's working out very well for us. So we'll continue with that. Key account growth. We're doing that through extending into different categories. Traditionally, we have been hair care, skin care, bath and body. We have played in lots of other categories, but there are some others that are coming through for us that are very successful, and that is gifting. So a much bigger focus for us in that arena, private label and brand. The well-being area, bar soap. As you know, we manufacture bar soap in our Devon facility. I've had more briefs come through for bar soap, including our own brands, in the past 6 months than I've ever seen since I've been in this industry for 25 years. So it definitely is a format due to the environmental concerns of packaging and in terms of sustainability that retailers and brands are definitely looking at. And fragrance. So we've always done big business in fragrance in terms of contract manufacturing, but we're now moving into fragrance with regard to private label as well and exclusive brands. So some really interesting developments for us in terms of product categories. Exploring new distribution channels. As you know, we've gone into TV shopping, and I think there's a lot more to go out there, particularly globally. So we will continue to focus on evolving that channel. And the travel sector for us is another very interesting one globally that we feel we can take advantage of, particularly with some of the brands that we have, like Feather and Down with regard to well-being and sleep. New market focus is the USA. As I said, we're launching with CVS on Curl in February, and obviously continuing to look at other opportunities in the US. And Germany remains a key focus for us. We highlighted that 6 months ago that we were putting some significant resource into Germany. That is still very much in the early stages, but there's presentations that have started to happen, and there's definitely some momentum that's beginning to happen there. So I'd like to think in 6 months' time, we're starting to talk about trade in Germany. And then, as I outlined on my final slide about the highlights of where we are, ongoing digital development and direct to the consumer. So obviously there's the opportunity with sales revenue there, but there's also that opportunity to get much closer to our consumer in terms of building our brands and understanding what the consumer wants. And we're finding that very useful in terms of making sure that we're developing the right products at the right price for the consumer. So Bernard is going to pop back up and do a brief conclusion, and then we'll answer any questions you've got.
Thank you. Thanks very much, Pippa. Thanks, Paul. Now we can talk about where we're going in the future and where we will be. Basically, the background is tough. Brexit uncertainty, currency fluctuations, trade tensions, high street mayhem, high-speed tech revolution. But if there are opportunities in there, we'll take them. In fact, Brexit uncertainty has helped us. We've got a lot more business because people are onshoring. Trade tensions, same thing. High street mayhem, well, a lot of the high street retailers are resorting to private label, which you've heard from Pippa, has been a great benefit for us. Improved our turnover, improved our margin, and improved our standing in the retail community. So if there are opportunities anywhere, we will take them. And I think we're well positioned for it. We've got great products. I think the unsung thing here is that our ability to develop really good products, test them, and make sure they appeal to the market is a very strong feature. We don't talk about it much. Pippa loves to talk about the market, and Paul likes to talk about the finance. But the reality is we can develop products quickly, and they're very well controlled, and they do what the consumer wants them to do. So I feel it's our job to consolidate that. So we're bringing in new people in the product development side, but sticking to the same old rules. We're strengthening our manufacturing base. In fact, we have Martin Hawes here, sitting right at the front. We just recruited Martin from Marshalls, previously with Boots, and before that with Mattel. He's a very strong background. He'll come up here with the rest of the team and answer questions when I've finished waffling here. But basically, we continue to hunt down higher margin contracts with each section of our business: private label, contract, and branded. Particularly where we can develop equally high margin for our customers. We're always very aware of what our customer needs are, and we always try to satisfy and get to their requirements as well as consumer requirements. So we're on trend. Like our Bam Beautiful is right on trend. Our sleep is right on trend. I mean, if you read any of the well-being magazines that talk about sleep endlessly until you fall asleep. So we're keen to develop as well as purchase brands as well. The acquisition of Balance Active has been tremendous. It's just right in our trend. It's got a great presence on the shelf. It does what the consumer wants it to do, and it's a very simple product. So that's our philosophy now, to just keep on doing what we're doing and doing it well. And we have so many good attributes in our company. We can manufacture, we can market, we're developing our digital, so that no matter what comes along, Brexit uncertainty, currency fluctuations, trade tensions, whatever, I think we can take advantage of them and make us and help us to grow and continue to grow. Maybe not as, the uncertainty has slowed down growth in general, but I think we will be able to continue at least at 6, if not 10% in the future. So if you guys join me up here, Martin can say a few words about his background here. Come on, get up there. You don't need this.
Thanks, Ben.
Good. Pardon, I stand here. Okay.
So, yeah, just a very quick good afternoon, everybody. As Bernard said, Martin Hawes, Group Operations Director. I think I am now 13 days into my time at Creightons. So, but first impressions are really good. I think, as the team have already said, from my perspective, it's a fantastic brand, fantastic business, highly agile, highly flexible, innovative and adaptable to really drive those market trends from a manufacturing base, which is where my background and obviously the core of the business, the DNA of the business exists. So hopefully some of my experience from the toy industry with Mattel, Boots for 8 years as their engineering director, and lastly Marshalls will help drive the business forward to achieve the growth that quite clearly is there as a great opportunity.
Ask him in 6 months' time what he thinks, because he'd be here. So we're ready for questions now, guys. Any?
Firstly, congratulations on a great set of results.
Thank you.
And dodging so many banana skins such as Brexit, and at the same time pushing up the gross margins. I think that's a great trajectory. You did mention, Bernard, that aspirationally going forwards, we should be looking for maybe 10% growth here on in. Does that still sit easily with, I think you had an aspirational target of 60 million by the end of next year. Is that still on?
The 60 million?
Yeah.
It might take another year to be. The high street mayhem, the challenges, they present a bit of a headwind. I think it will take an extra year to do that 60 million, but it's still on. We're still there, and we're still well positioned to do it. We did pursue an acquisition there of 10 million, a 10 million digital company. We decided not to do it at the end of the day because it didn't fit properly, and we walked away. In fact, they walked away. They got so fed up with our due diligence and our requirement to meet our targets. So that was a bit of a disappointment, but I think it was the wisest thing to do.
Okay.
So that stopped us hitting the 60 million by the end of next year, but we'll be there very shortly.
We'll get there.
Yeah.
And I think the last time you presented, it was mentioned that the order book was incredibly strong. It was, if I remember rightly, it was up 25 or maybe even up 28% compared with the previous year. And it doesn't quite seem to sit with the turnout for the first half of plus 6% over the corresponding half last year. I can't quite reconcile this, the order book to that.
I'm not sure exactly what we said last time, but basically the sales were up 33%, and as part of that, the order book was up. But year on year, the order book is as high as it was last year, which reflects the 33% increase that it was last year. It's still there. That momentum is still there. It hasn't increased more than 6 to 7%. Right now, it's probably 6 or 7% more. I'm not sure. 6 or 7% of the order book than it was last year, but I don't think that reflects anything adverse. It just reflects the fact that we're not growing at 33%. We're growing at 6 to 10% now.
Yeah,
that's a fact.
Great, thank you.
Martin, maybe you could just say a little bit more. I mean, you've only been there a few days, but in terms of the opportunities in front of you, what excites you in terms of what you can contribute? What areas do you think you can make the most difference or focus on over the next few months?
I think obviously it's still very early days. I think if you look at the latent capacity to be able to actually drive more volume, assuming we get the sales growth through it, to drive more volume through efficiently and really drive the productivity numbers, both in Peterborough and also in Devon. We have Certainly the Devon site is a lot smaller, but it's well invested. It is, we're starting to look at specialisation now. So pretty much alcohol, fragrance and soaps down in Tiverton. Peterborough, a lot more flexibility. The profile that I'm seeing at the moment, obviously, I think we've just had our record sales month, record production months. So the factory feels, particularly on the first shift, is highly loaded. But there are clearly significant opportunities in terms of that latent capacity. And if we can drive additional sales and leverage the overhead of the business, I think that's the real opportunity in the short term. I think the longer term is some of the aspirational volumes that we're talking about. The purchase of the site gives us significant opportunity to develop the manufacturing base really for the future. And that's the sort of 3 to 5 year view. It's one of the reasons that I was really keen to join the business, because the opportunity there is significant. And I think that's, I think if you walk into any business, you can see immediately short-term gains and potential opportunity. But when you look at the strategic position and how the business, and particularly the manufacturing operations, are positioned, I think there's huge growth and huge opportunity in there.
Okay, thank you. Maybe just one extra one, mostly for Bernard, I suppose. The operational gearing is reasonably clear this year, so reasonably small growth in revenue, but you've improved margins and already ahead of Martin joining, maybe improved efficiency a little bit ahead of time. But then whenever we get right to the bottom line, the diluted number of shares, as Paul mentioned, is bringing down earnings per share. Is that likely to be an ongoing feature in terms of the level of staff motivation through shares, or was it a large one-off that we saw?
Well, the answer is yes to both questions, but it was a large one-off, and I don't think we'll repeat such a large one-off. Mm-hmm. But I think we'd like to keep the employees motivated, and I think the shares do motivate them. Our Martin is an investment for the future, but our manufacturing, and most of our employees are in manufacturing, they will deliver no matter what. Whether the machines popped up, they'll work all night, they'll do whatever, they get it out, they get the stuff out in time. We just need to have a better manufacturing system for the future, and Martin will take care of that. But I think it's up to us to take care of the employees, because they deliver. Pippa does a great, and our team do a fantastic job in increasing sales and delivering to the customer and delivering great products. But we get them out through the door on time, every time, to the right quality. And you've got to motivate the people who do that, as well as the people who sell it. And they're pretty lowly paid. I think our average pay is about £8.50 basic, and we end up at about £9, just over maybe £9.50 after you count the bonuses. And they're tremendously motivated by the shares, so I would like to continue that, but not to the same level. Certainly not to the same level.
Feeling of the shape of it.
I hope that answers the question.
Forward. Yep, thank you.
Yeah, so I've got congratulations as well, but I've got two questions. One, just follow on from that. In terms, can you just talk a bit about, one, how many shifts you're running at the moment, and what's the job market like in Peterborough in terms of retention, particularly over Christmas and longer term?
Okay. Well, the first one, we run 2 shifts, a morning shift and an evening shift, finish at 10:30. The labour market in Peterborough has always been pretty tight, but we do pay reasonably well compared to the rest. And a lot of the demand for labour at our level would be like Amazon and the warehousing companies around Peterborough, and they're usually difficult shifts for people with families and things like that. So we offer a better shift pattern. Martin might like to talk about this. Maybe it's a bit early days for him, but basically we don't have any worries about that. Martin's job for me is to make sure we can do twice as much with the same number of people in 5 years' time. So we want to improve our efficiencies, increase our capacity, but without increasing our demand on the workforce. Now that it's not a magic wand or anything like that, but that's the strategy, that's the investment, that's the intention, because this is an investment. We might be able to make, say, 10%, but we are investing in digital, we're investing in manufacturing, and that'll probably keep the net bottom line at around 8%, 7 or 8%. And I think that's a deliberate policy on our part. We're not dressing the company up for sale or trying to do wondrous things. We're just doing more of the same and trying to do it better every day.
Sorry, and
Would you like to say something, Mike?
No, just to echo, I think there are certainly opportunities in terms of looking at the balancing between the shift patterns that we've got. Certainly in Peterborough, where I've been spending the majority of my time at the moment. I think, as I say, there is this latent capacity, both in terms of the way that we do things and just physical capacity in the facility itself. Again, it's quite easy to come in and see when you look at the labour profiles between our temporary and agency employees versus permanent employees. In certain areas, depending upon the profile of production requirements, it can get a little bit lumpy and a little bit difficult to manage. As I say, I'm only seeing it in a very small snapshot at a peak. I think, as we get into January and February and production volumes start coming down a bit, it'll be a little bit easier to get the overall picture and how we can balance that profile much better across the shifts. But yeah, I think it's the activity levels at the moment are significant in Peterborough, and I think it feels like there's a very highly motivated workforce doing everything they can to get the product out the door. Very, very significant focus on service levels, and it's almost like nobody's got time to breathe because we're really pushing volume. As we get forward, I think that ability to then look at the efficiencies and look at the balance a little bit better, right the way through from scheduling, planning to the manufacturing output, I think there's significant opportunity in there.
Thank you.
Sorry, can I one more?
Oh,
Sorry.
yeah.
Which is really for Paul on the free cash flow generation and the cash. By my calculations, the last 12 months you've generated about 4.5 million of free cash flow.
Yes.
And you went through the working capital on some of the reasons for that, but it's also come at a time when growth has slowed down in the top line. The top line.
Yeah.
And I wondered if that was a key driver of that. In previous years, you've shown strong growth, but actually, you've been using cash rather than generating cash as it's gone into working capital.
And yes, that's almost inevitable. And then the nature of our business, a high proportion of it is for make to stock for customers to call off. So when we're driving either our branded sales or private label sales, we are of necessity increasing working capital and investment in stock, and the same with debtors. It's a function of that. We get some back on the creditors. My rule of thumb is roughly, for £1 million worth of sales, we've got to spend. We're investing about £200,000 worth in working capital, unless it's a contract business where we make to order and ship straight away. What I'm trying to get across in that is that we managed in that 26% growth last year. We did invest in working capital and we got up there, but the business is generating enough cash to support a growth of that relatively comfortably. In this last 6 months, that because we haven't needed to make that investment in the working capital, the business is generating cash that we can use elsewhere. It's enabled us to buy the site, and it's enabled us, which should have big benefits for the long term as we look at reorganising it. For those of you who've been there, it's there's a lot of spare land around it that we can take a lot of opportunities to look at warehousing, etc. But also it gives us an opportunity to buy things because we're generating cash, whether we invest it in another brand or invest it in working capital to support growth. We've got the business is underlying generating enough cash to be able to do that. I don't know if I got that across, but that's the real message. Yeah.
We were preparing to buy that digital company, and so part of the build-up of cash was, we would have had a choice 6 months ago to buy new machinery or do whatever, but the decision was not to build for Brexit, not to buy new machinery, but to keep our money for the acquisition. It didn't come through. We will get an acquisition somewhere along the line that's appropriate, but that didn't come through. And so we've got enough money now to go out and look for something, another Balance Active, for example, which Pippa negotiated very, very skillfully and very well for $500,000, which was brilliant. So we've got our money back on that, and we will do another one with that money, because I'm very aware it reduces the rate of return on capital.
We've got money
Too
sitting
much
in the
money,
bank.
you don't want too much.
Yeah.
Sorry, David, you want?
A range of questions from me, but first of all, well done, all of you, and you certainly wooed the delegates at Mello last week. Were one of the most popular companies, and
Great.
it's not surprising why.
Thank you.
But just mentioning first the B word, and you quite rightly said that you had no longer been needing to stock up, and that was unwinding. But what about your customers? Do you think they have still got stocks that they'd originally bought through the period that they were needing to build it up, or are they unwound as well, and you might see follow through now from?
Not in terms of retailers, because retailers we deliver day one for day three.
Okay.
So none of the big retailers, they were expecting suppliers. You would have seen, particularly with food, and they expected suppliers to take the heat on that. And we got everything we did underwritten by them. So we weren't exposing ourselves in terms of they were never going to take the stock. So that element of the business, no, our customer. In terms of some of the contract manufacturing accounts, again, we offered extra stock holding facilities for those, because some of the brands, whilst premium, are quite small. And again, whilst we got it underwritten, they weren't forced to take that stock per se. So it is flowing through. So there may be a few in there that maybe have a little. Had a conversation with one earlier this week that's probably got a little more stock than they would want at this time of the year for that reason. Not just from us, but from other manufacturers. But it's not a big concern.
So even with things like gift orders for Christmas, if necessary, you could get them refilled on the shelves quickly.
Yeah, and gifting didn't really get affected by Brexit at all. Nobody changed their volumes or their buys or their commitments on gifting. Even if it had happened, in October, gifting was not coming into it. It was really beyond, because gifting really gets made in June and July. So it's done early anyway, so yeah.
Okay. As far as knowing your customers, your end customers, not necessarily your large customers, I guess the online channel is your best way of knowing what they like to have, how regularly they buy it, and, which brands are really going to be popular.
Absolutely.
Are you seeing that as being a useful trend? Do you have sort of groups, focus groups of any kind that you?
Can I take that one?
Yeah.
Yeah, the channel that tells me more than anything else is that more of our shareholders comment on our products. Actually, 3 years ago, none of our shareholders used any of our products. Now, your daughter uses our products.
She does.
So that's where we do keep.
All the students at her uni are going to be using your product.
Yeah. But and the online helps, but actually we keep close to our consumer most of the time anyway.
I mean, we get EPOS every week, which is the till sales from all of our big retailers. So we analyse every single retailer, and I now get EPOS from our international retailers as well. So I can literally see every Monday morning what's selling through the tills anyway. So yes, it adds to that. The dimension it actually gives us is more the dialogue with the consumer as opposed to what they're buying, because we've been getting that from bricks and mortar for years anyway. The added value is we can now have a dialogue directly with the consumer. They call us, they talk to us, they write to us. We use them for focus groups. I've currently got some new developments going in our blonde. We're sending samples out to them. We're getting their feet, because we know who the big blonde users are in that market that are buying from us. So absolutely, we're taking advantage. And if you give them samples and freebies, they're happy to.
And I mean, the big growth in private label, which is great, but I do wonder who else is able to supply that market if it's not you. Who are the competitors? How many of those do you lose as opposed to
That's a good question. We don't lose. I don't think we've lost anybody in 5 years. In my time, have we lost? We lose the odd one, like the Hut Group, for example. It decided to buy its own manufacturing, but it's kind of. I think we develop it to a higher level than most other suppliers.
Yeah, I mean, on the private label, you're talking about private label competitors, David, in terms of who we're competing with.
Yeah.
I mean, like I said, one of the big customers for in the UK, we won Supplier of the Year Supplier Award of the Year this year, in a room of 500 delegates with Unilever, L'Oreal, all the big branded players, and Creightons wins Supplier of the Year. And when they announced it, they said it was a combination of how we work in partnership with them, how we understand their consumer, we deliver on time, we bring them innovation. And they said they really understand us and they understand our consumers. And that was just a huge accolade in terms of my team getting so close to that retailer and that retailer's consumers. There's not many private label companies in our competitor set that I think focus very much on the consumer. They focus on the retailer. Now, you do have to focus on the retailer agenda, obviously, but you've got to focus on the consumer too. And the partnerships, retailers that I say I want to work with understand that, and they understand the value that somebody like us brings by understanding that entire chain, if you like, of sales process and marketing process.
Yeah, I'm only trying to gauge whether there are many out there and they might be able to undercut you or, hit
If
your
they
margin.
undercut on price, that wouldn't be a concern for me, because that's probably not business we want anyway. We're adding value. I mean, this particular customer I've taken a new category to, and they've never considered that category, and I think they can own this category on the high street. And that's what other private label manufacturers don't necessarily go and create new categories, because I'm thinking about who's coming through their door, what kind of consumer they want, and I know we can make this certain type of product, and I'm thinking this retailer could own this category if they get it right. And we went right to commercial director level, and they're like, we have to do this, this is just amazing. So it will step change for them, something in the well-being sector that they've never done before. A lot of private label manufacturers behave as manufacturers, hence the price and the margin point you're making. But if they want to undercut and want to do that kind of business, that's probably not where we want to be anyway.
On the margin growth, can I just understand, is that because of overall improvements in efficiencies, or specifically because of the change in the product mix and there being more private label in the product mix?
It's a combination of a number of things. Paul talked about the reduction in costs by better buying, and Pippa has taken a lot of action in terms of who we sell to. The pound discounters, I think, we're more or less out of at the moment. But you might like to comment.
It is a combination. It's product mix in terms of, again, focusing on those added value concepts. So making sure that we're bringing products to retailers that aren't just basic personal care, for example. So we do a lot of scrubs, we do a lot of facial skincare, we do a lot of very innovative formats that, again, a lot of private label manufacturers are not investing in, so that differentiates us. The team and I, along with Paul, every quarter we meet and we look at every margin, every product, and we actively have an action plan in for every quarter to move the needle on products that we think are falling below where we need them to be. We either exit or we re-engineer packaging. So a lot of it's been packaging in terms of, if you think efficiency in manufacturing is probably only about 10% of the total product cost in most cases. So the real impact can be in formulation and packaging. And you've got a lot more flexibility in terms of where you can buy that packaging from, how you print it, where you source it from, the volumes that you buy it in. So there's a lot more flexibility in terms of being able to move the needle on cost. There's been a lot of work in cost engineering as well on formulations and packaging.
And that's been done in conjunction with private label suppliers. How do we help them improve their margin and at the same time improve our?
We're going through a big program actually with the big retail I keep talking about on private label to reduce packaging, because obviously that's a huge dimension. But reducing packaging is also reducing cost. We're literally removing some packaging from products, which retailers demanded that you did before. Now they're getting smart, and we don't have to have 2 caps on something. We can remove that. It maybe doesn't visually look as appealing, but it's just changing the perspective. Removing cartons from products, removing trays from products. So we're making sure we get some of that gain as some of the retail, because we're saying to the retailer, if you want us to drive this, we want some of the gain. So there's a negotiation piece to be had there. So that's driving it as well.
And then, if I can, one question about the property purchase. More than one, actually. Does this reflect the chairman stepping away from the business some more, him selling the property?
No, sorry, I'll answer. If I answer that one first. William bought the property from a landlord after he'd already bought shares in the business. His premise at the time was it gives the business security. He always said that when the time was right for him and it was right for us, we would have the option to buy that. And those circumstances came together. It was a related party transaction. It was obviously independently valued, so there was nothing. But there was nothing more than, I suppose, the completion of what he always said he would do. So it's not a question of him stepping back from the business. And
I think he could step back from the business without, all his decisions are made on how much money he makes. It's not about stepping back from the business. He could step back from the business without selling the property.
So and the HSBC mortgage, 15 years, is that an amortizing basis? Is it got a sensible margin on it?
Yeah, the actual interest margin's 3.04% on. For the first 10 years, we fixed that at 10 years at the time. We felt that was the best thing to do in the circumstances. We'll find out in 10 years whether it was the right decision. So yes, it is. It's repaid annually over 10 years. The fixed for 15 years, but fixed for 10 years.
Okay, thank you.
Yeah.
Thank you.
Just another one from me, if I may, and maybe going back to something I mentioned last time, just about branded. So you've grown quite a bit in private label, but branded percentage-wise has dropped a little bit. I think from 22 to 20,
Yep.
you said, and you've maybe got an amount of revenue growth. Was it 6%?
Yeah.
So overall, does that mean branded is roughly flat on last half? I haven't calculated
Pretty
the
much,
number.
yeah, pretty much.
So
but we're delivering more bottom line margin through branded.
yeah,
even
so
though the
I
revenue's
just
down.
want to try and clarify maybe what the future is for branded, because quite a lot of the presentation was based upon, you know, what's going on in branded and various successes, but overall, you know, you've probably cut out or you've reduced in some of the lower margin areas. Is there a point at which, you know, you've cut those low margin bits away and you feel that branded will start accelerating a little bit further, you know, because of all the work you're doing on it? Because, you know, it sounds like there's a lot being done, but overall the revenue in branded isn't.
Yeah, I mean,
isn't
for me,
growing.
it's about creating that base that was the right margin mix with the right customers. And as you know, when we entered branded, we entered at the very value end of the market with pound lines. And over the past 5-6 years, we've been building up our profile, both in margin and in terms of retailer profile. So, you know, originally we were in Poundland and Pound Stretcher and Home Bargains, and that was our portfolio for brands. And now we're in Boots and we're in Morrison's and we're in Asda and we're in great retailers globally that are not in that value sector. They're in, you know, mass or masstige market. The difficulty with what we call equity brand, which are these higher retail brands, is obviously they bring the margin, but they don't bring the volume revenue as easily as literally trading, if you like, at the value end of the market. But the margins are much healthier. And I think we've created a really nice base from which we can now move forward. And like I said, we've brought in additional sales resource that is dedicated sales resource for brands to push them globally and the UK. So the aspiration is that we've created a base from which I think we can move quite nicely. I would like to acquire another brand in the skincare space if we could. That, you know, if the right one comes along, that would absolutely be great. I think this is going to deliver actually more than I hoped. We've got a nice big MPD program on this. We've got new SKUs coming out on this because it's quite a tight range. It's only about 8 SKUs in March, April. So I think that's going to help drive more growth. And this is nice margin too, which is great. So yeah, it was about building a platform because again, in that value end, it's trading and there's only so far you can go. And now that we've got brands that I think have got a much wider appeal and wider profile, that we can get into other retailers and keep moving it forward. It doesn't negate actually trading at that end because we've got some great customers at that end of the market that are making the margin for us. So we will absolutely continue there. It was just getting the balance. It was getting the balance right.
Just maybe 2 extra things on branded, if I'm not asking too many. We don't seem to see much in the presentations about the broad oak type high-end products. Presumably they still exist.
Yes.
How are they going? And secondly, I forgot the second one, but if you answer
So
that,
yes,
I'll
as you
remember.
know, the broad oak was a contract manufacturer. Didn't do private label. Didn't have any of its own brands. So what was appealing to us was the high-end contract manufacturing accounts that it had. And yes, absolutely, they are all still in play. So we're still manufacturing really great fragrances and high-end skincare, high-end bath and body lines. They're all very much still happening.
Okay, so
Absolutely.
they're all...
Certainly, sorry, if I could just, the thing for me in broad oak was that it would give us better knowledge, better background in those high-end areas, so we could eventually develop our own brand, and we will do.
Yeah.
But it takes because I had a go at this maybe 10 years ago when I spent 200,000 developing the Potter Moore range, which we had listed in Takashimaya, in Henry
Selfridges,
Bendel's,
yeah.
Selfridges, Harvey Nicks, it sold us ground to nothing because we didn't know the way to sell it, how to develop it, and what were the key SKUs within each brand. It was a bath and body range, really, and we try to put it in the high end instead of being a fragrance-led range, high-end range under the name Potter and Moore, vintage, and all the rest of it. We can do that. We're not quite ready for it yet, but we will do if we don't buy a high-end brand in the meantime.
Yeah, no, I get that contract can be a good place to learn, I suppose, for your own brand.
We've learned a huge amount, and we are in daily contact with retailers and brand owners who are at that high end, and we're learning every day.
The other little bit that I'd forgotten earlier was you were talking about your, I've forgotten the name of the range, but the £1 versions that you're now upgrading to £2 with a nice new label and some Body Bliss. Yes, thank you.
This is all Pippa's idea.
Yep.
So
she's right.
do you think you'd be able to maintain volumes at that significantly higher price point? I mean, you said you sell them more expensively overseas.
Interestingly, in the international market, they were already at higher retailers anyway. So the movement it's making in the international markets is actually just a little bit of a movement. It's like the equivalent of 50 pence, if you like, in terms of retail. So our core, it was mainly an export brand anyway. Right. And in fact, I wasn't succeeding in the UK with that brand because it was too low value. So now we've got the attention of a number of the major grocers on this brand. Okay. Because we're putting it at a price point that is more attractive to them because they don't want the pound price points anymore because obviously Poundland's got that market. So the export markets have reacted positively to it because they're effectively getting a better product in terms of the claims for pretty much the same amount of money and the same retail positioning. So that's great. And in the UK, we're now attracting and presenting to mass market retailers to move it up in the UK. So my hope would be is that we can also get 1 or 2 mass market listings in the UK, particularly probably in the grocery sector with the brand, which would be great.
Bernard, Pippa, Paul and Martin, thank you very much.
Thank you.
Yeah, thank you
very much. Thank you.